Hello and welcome to March's Q&A podcast. Thanks for joining us today. I'm joined by three individuals this morning. Paul Durrans, Investment Director, Diane Patterson, Head of Delivery, and Jen Cumberledge, Quality and Training Team Leader. So welcome to you all. As per normal, in the Q&A podcasts, we'll be taking questions from yourself, the viewer, and also hopefully giving you the answer. And hopefully coming up with a little bit more information. We are in March Q&A, so March being end of tax year, a very important time in financial services and very important time for the end client as well. So thank you for joining. So first question, from my point of view and from an advice point of view, specifically relevant for tax year end. What happens if I don't use my allowances this tax year? So from a pension point of view, you can use your previous year's allowance, but if you don't use it in that particular year, you can roll back a further 3 years. For an ISA, it's not so straightforward. If you don't use your ISA yearly allowance, you lose it. So you can't roll that forward or double up. But the benefits of doing so is that once it comes to the end of the tax year, so if you use your 20,000 allowance for that year, there's only a day later where you can top up and use another 20 allowance. So benefits of doing so, and also benefits of also speaking to one of our head office staff if you're unsure on your allowances. If you might have used your ISA allowance in the tax year, you might have not the full allowance, but you might have a little bit more to top up, or you might have half of that. If you actually go onto your app will tell you how much allowance you have. Well, like I said, ring our customer care team and they will be able to guide you on what your allowances are left. So, most important considerations for clients ahead of the imminent tax year. From a financial advice point of view, I would say fill up your allowances and use as much as you can. But also as well, it's a good opportunity for you to have a chat with the head office team. You may wish to talk about the current income that you're receiving from your pension. You may wish to talk about, like we said before, how much allowance you've got left. So it's always good to either speak to our relationship management team here at Newcastle, or if you wish to have some financial advice, they will book you in with a financial advisor as well. So it's really important. And a lot of people use tax year end to really have a look at the finances and prepare for the next tax year moving forward. So if you do have any questions, contact us at Newcastle. Okay, so I'm going to throw another question which has come in, and this is probably one for Diane from a tech point of view. So Diane, what tech updates are in the pipeline at True Potential at this moment for Q2 and probably looking forward and beyond?
Am I allowed to give some trade secrets away?
I think so, yeah.
Right, well, funny that you've just mentioned the app and the services that are offered on there. We talk about impulse save and direct debits and things that I think we now just think are run of the mill. But what we've kind of taken stock, and I think what is apparent is that not every client knows what services we have. So within the website and the app, the two now sit hand in hand. There is going to be a services section which will tell clients the services that they can get from us, the services that they can find within the app or the web should they need them. There will be frequently asked questions. So as opposed to having to wait for someone to respond to something that might take you sort of 10 minutes to Google, if that's what you are doing by nature of your normal daily research, you can go into the services section within the system, and it will give you all of the services that we offer in True Potential, like I say, as well as around the app. And I think the other one that the viewers will most probably like, I'm trying to think, because a lot of what we do, I think, as I said on the last podcast, a lot of what we do is also behind the scenes in terms of regulatory.
And I think also as well, you said, Diane, I was in the same podcast, we did say we won't release any technology really if it's got no benefit for the client.
Absolutely.
Yeah.
There was another, again, AI is everywhere. And I think I said again, maybe a few podcasts ago, we will only dip our toe into something if we think it's beneficial, much like you've said, for clients, but also if it will work within the regulatory environment that we're in. So we now have the the dipping of the toe of AI that we did has been rolled out now. So clients can go on and reset passwords and things 24/7 as opposed to having to wait for an end user to validate their security and allow them to do it themselves. We will be further enhancing the AI processes within the team. So an advisor might need to go on and ask the investment section to do something on behalf of their client. We're now going to make that a little bit more seamless in terms of the AI processes that obviously sit behind the system, so that, again, an advisor doesn't necessarily have to wait for an end user within the investment platform to respond to something that they want. We can send things like that. So we're trying to get automation in as much as we can, which will benefit both advisor and client.
Yeah, and I suppose AI is obviously massively affecting every technology company around the world, and True Potential is no different to the fact that if we can improve the end result for a client, we'll incorporate it where we can.
Yeah, I think what people don't understand about AI is it's not this, while it's called artificial intelligence, it's not just learning from itself. What it has to have a huge collection of data points behind the scenes so that it can understand the logic, you can give it a tone, you can give it a context, and it builds up a picture of what it is that you're telling it to build up the picture of. So again, most commonly asked questions and themes, as opposed to a user having to be there to respond all of the time, we can convert those into the data points that AI will look at, and that's where these responses come from. But if there's anything at all that the system might not be sure on, it will then throw that to an end user. It won't just merrily carry on doing what you assume it will.
Yeah, and like we said as well in the previous podcast, we test the tech updates ourselves. So we know that when it goes out, it's pretty much been tried and tested to the max.
Yeah. I did remember what the second thing was. So hyper-personalisation.
Yeah.
So within the client sites, again, we will present things to clients that we know that they like, and certainly the features that they've asked for. But when you go onto a website, you're usually governed by a template. So you know what the header's going to look like, you know what the items on the pages are going to look like, you'll know the format of it. That's the way that our sites are largely built. And what we've done now, again, kind of AI, but not, we're looking at hyper-personalisation. So the things that I might want to see, what I can put on my overview, you might want them 2 or 3 clicks into your website. So we're going to be rolling out the ability for clients to say, well, actually, I want to move, because I work here, I'm part of these podcasts. I wouldn't necessarily watch them within the True Potential app. So I might want to move them down on my website. I might want to move, because usually I'll log in, I'll look at the value, and then I might look at the overview or the graph. I might want that higher on my website. So we're going to allow clients to personalise it a little bit more than
a little bit
can be.
Like how you just organise the apps on your phone. It's just going to be more relevant to the app itself. Okay, great. And another question, probably more investment related for you, Paul. Within the current market, we know we've talked about the last couple of years, which have seen a lot of volatility, but also great performance for the portfolios in the last 3 to 4 months. Is there, in this current environment, is there an advantage to what we do, multi-asset investing, and a global invested approach?
Yes, absolutely. I would say the big advantage is diversification. So if you invest in one individual stock, let's say Apple, you are exposed to idiosyncratic risk. So the return you receive is very much dependent on how Apple performs. So we actually diversify. So we're investing in many different stocks, but we go further, invest in different asset classes such as bonds, alternatives. And through that diversification, it really smooths out the journey for the end client, but doesn't compromise on the return. So when we invest, we are investing in different asset classes, but also different geographic regions. So we're not just investing in the UK, we're investing in the US, Japan, Europe, and really that increases the opportunity set for us, and it allows us to find opportunities that may have a better outlook from a return perspective, but also bring different diversification benefits. And by having that wider opportunity set, for example, if we were just investing in the UK, over the last 10 years, the return you would have received on average each year would be 5% from the UK FTSE 100 market. In the US, the average return would have been 13%. So by having that wider universe, there are great benefits to that.
And I suppose from a diversification point of view, Paul, the reason why we believe in diversification, we have it so apparent in all of the portfolios, is if one area such as the US doesn't do well,
Exactly.
Being diversified and invested in different areas, that allows us to somewhat not control the volatility that's going on in the market, but give more of a unified approach to performance.
Exactly. It smooths out, it dampens the volatility. You use the example US, UK. You can look at stocks. When stocks don't do well, bonds might do well, or gold might do well.
Yeah.
So it's smoothing that journey, but it's not compromising the return.
Great. Okay, fantastic. And, going back to maybe the tax year end point of view, there's a question in which I'm going to obviously throw across to you, Jen, and you, Diane. How much can I top up my pension, and how can I do it? So maybe it's that one for you, Jen. The cut-off dates, and sort of talking about impulsive. When is the latest people can do stuff over tax year end?
Yeah, so how much can you put into your pension? So you've got your £60,000 allowance there that you can use, or you can use that up to your relevant earnings if it is lower, and that's your contributions that you'll get tax relief on. And in terms of topping up, you need to take into consideration as well your employer contributions. Mm-hmm. So in terms of the cut-off dates, with the Impulse Save feature on the site, you've got a really easy way there to just put the money straight into your pension from your debit card. So just as you would if you were going to buy something online. And you can do that up to the last minute on the 5th of April, so the last minute on the last day of the current tax year.
So there's a lot of tools people can use, Impulse Save being the most immediate because of obviously the fact that it's instant. And I guess that as well, I know from my point of view, from an advice point of view, and yours from a sort of a relationship managed point of view, we do get very busy around tax year end. And it's a great opportunity if people who have busy lives, just want to make that payment, they maybe want to put a smaller amount into their ISA or their pension, they can use the Impulse Save feature from that. And does that come straight from their account?
Yeah, absolutely. So straight from their account, they'll receive a receipt straight away. So you'll know that payment's went through. And as soon as you've got that receipt, then you know that it's been counted towards the current tax year. So it's really secure. You know that it's went in on time. Mm-hmm. Another thing probably worth mentioning, we do get some clients that want to do it this way instead. You can't send a bank transfer as well. I'd recommend kind of checking that out with your bank beforehand though, so you need to know whether they're paying backs or chaps, and it needs to be in our account on our side by 6:15 on March the 5th as well. So I would just double check if you are going to be doing it that way instead, that you make sure you're definitely getting that in there on time. Where you can, I'd definitely recommend using the Impulse Save.
But if you're unsure, you can ring our relationship management team who can give you that information on the various options as well. So a really good point there. Another question is about an annual review. Now, for viewers who don't know what an annual review is, we have an obligation to review clients' portfolios and performances and investments on an annual review. Now, I had a hand in this at the original start because I looked at and designed the annual suitability review, which was a regulatory requirement for advisors to do that. But we probably do it a lot easier than a lot of our competitors and a lot of investment companies. Diane, do you want to just give an overview of what the annual review system is and how it works?
So when you said that there, I thought back, that was 2017 or 18.
Yeah, a long time ago.
Where we looked at that, and it's just mind-blowing that we've been doing that now this long, digitally.
Yeah.
What we do is we take the client's current situation at a point in time that's been agreed with either the client or there has been an event within their circumstances. So they might have been given a piece of advice. That advice will naturally require a review within 12 months of that date. So there are scope to move it maybe a couple of weeks, I think, before and after, but the review itself needs to take place within an appropriate amount of time after the advice process. Mm-hmm. But what the system will do is it will harness everything that we know about the client at that point in time, and it will give them the current valuations, it will show them their assets and their liabilities, it will ask them whether there's been any material change in their circumstances, and what that will then do is it will generate a document for both the client and the advisor that says whether there are any actions that a client might need to take, or any actions that an advisor can't just skip past. So let's say, for argument's sake, a client says, actually, yes, there's been a bereavement and I've been left X amount of pounds.
Yes.
That's something that advisor probably does need to know, whether there's anything to be done with it. It might be £1,000, it could be a huge amount of money.
Yeah.
Then the system will allow the client to say, actually, yeah, this just happened last week or whatever it might have been, and it will inform the relevant person or people that the client really should be spoken to.
Yeah, and the client gets alerted to that annual review via the client site or their mobile device, I suppose. And it could be something simple like, they're saving £1,000 a month, and they've just informed us that they've lost their job.
Yeah.
And we have an obligation to review the monthly amount to make sure the client can afford it.
Yep.
But also as well, it could be something like risk, where they want to change it. And from a relationship management point of view, Jen, we get quite a lot of queries in, don't we, from an annual review point of view. And we can help the clients complete that, can't we?
Yeah, of course. So it's something that we're working on at the moment, and that's quite big within the team. So there's a dedicated team there that are in place to, when someone has completed a review, have a look through what the results are, and if anything's changed or there's anything off the back of their action plan, give them a call and just kind of check in, see if anything does need done.
Yeah.
And it just means that we can then kind of ask you any questions that we need to do, gather any information that might mean that if you do need to speak to an advisor, we can pass that on, and then the whole picture's there for when the financial advisement appointment does come
So there
around.
are times in that review where they might want to speak to a financial advisor, and we'll just put that in the advisor's diary and they'll go through the annual review. Good. But from a technology point of view, it's really quick, paperless process, but a really good review system we've had in process for quite a few years now. So if you have any questions about your annual review, or how to complete it, or you want to know, the ins and outs of it, call the relationship management team and they'll quite happily put you in with an advisor or speak to one of their staff. Okay, great. So another question, probably for you, Paul, quite specific. With the release of the UK CPI data this week and the recent budget, can the government be seen to have an effective economic policy? That question's from Paul.
Toughie. I suppose I would separate them. So the inflation data is the Bank of England's responsible for getting inflation to its 2% target, and what we've seen this week is inflation has continued on its downward trajectory. It's actually coming in below the Bank of England's forecasts, and it's expected to get to 2% by the spring this year. So that's good news, and it's actually coming in below market expectations. So that's encouraging when we think about interest rates this year. Expectations, or the market's expectations, are that interest rates will be cut. First interest rate cut to come through in August. But there's still some components within the inflation basket, such as services, which is still quite elevated and is making the Bank of England a little bit cautious. If we move to fiscal policy, or thinking about whether economic policy has been effective from a government perspective, and we had the spring budget at the start of the month, what we found is that the growth environment in the UK has been very, very low. So if we look at the forecasts at the moment, the OBR, so that's the independent body who looks at the UK's public finances, is expecting growth to be 0.8%. Now that's very, very low. If we contrast that with the US, expectations are for 2.1. So their growth environment in the US is much, much stronger, much more robust. Where here in the UK government somewhat hamstrung by the amount of support that they gave during COVID through the furlough scheme. And so investment at the government level, but at the corporate level, is low, growth is low, and that just makes it more of a challenging environment. And that's why we see great opportunities in the US, because their growth environment is so much stronger. And so not great outlook for the UK, unfortunately.
No, but that's a good part from a positive point of view around the diversification.
Exactly.
About holding maybe US equities or increasing that, that share of every portfolio, so we can seize those opportunities if there are opportunities in different geographical areas, I suppose.
That's the importance of it.
Okay. And with any of the investment information and the questions that you have, we do have the morning markets as well, which is on the app. every day. So if you want to have a look at what's gone on the day before or in the week, then have a look at that part of the feed. When you open up your app, it'll be right there, so you can have a look at the latest investment information from Paul and his team. Okay, just more from a tax year end point of view. Does tax relief count towards my annual allowance? I'll pass that one over to you, Jen.
Yeah, so tax relief would count towards the annual allowance for a pension. So you've got your gross figure that you'll kind of need to work towards. So say it's a £60,000, you'll be able to make a personal contribution, and then the tax relief would count towards that as well. For an ISA policy, not something that you'd need to consider. So it is just something that's relevant to your pension policies. So if it's something that you're not sure of, you do have your allowance there that we can kind of check out for you.
Yeah,
if we
so
need to.
pension's got the annual allowance of 60. You'd have to contribute less than that to obviously fill that allowance up. But with an ISA being tax-free and your annual allowance only being, well, £20,000, you can contribute the full 20 from a tax point of view. So it's a good question. But like I said, on the allowances, if you do have any questions on that, contact us directly and we can guide you. Or if you have a look on the app and in your particular product, your ISA or your pension, it will tell you what your available allowance is, even if you contribute monthly. So it'll tell you what you can top that up. And like I said, if you do want to do it, or you are doing it last minute, you can use the impulse save feature, which will take that amount straight from your bank and invest it. And also, more importantly, from a pension point of view, when you do contribute from your own bank and you put money into your pension, it automatically adds the tax relief in there after around 5 or 6 weeks. So a really good way to obviously max your tax allowances as well. Okay, so next question. Do you tend to contribute your pension or your ISA first when using your annual allowances? Maybe it's one for you to start, Diane?
So it will depend, because I contribute to both monthly anyway. So I think if you were to look at it, it's probably level pegging for me. But I think if I was to, let's say I had the £60,000 to contribute 40, 45, whatever it might be, to contribute in cash versus the 20 into the ISA, because of, I think it'll depend on, I can talk personally because of my age and where I really should put the cash versus if I was a different age, maybe Jen's age, where I'd want to put the cash. For me, it's always going to be a pension first. I want the tax relief. I want all of the free money I can get that I can harness that will go towards my pension future, whatever that might be. And then I would subsequently follow that up with the ISA allowance. But I think I completely get that you've got different circumstances. So there will be people that don't want to lock. If you've got a big chunk of money to contribute, you might not want to lock that away until you're 55. You might have a different goal. It might be a house. It might be university fees and things that you're going to need to, I suppose, get out before that date comes. But personally, for me, it would be pension first, then the ISA. But like I say, I have direct debit set up because I'm a good client.
Treat it as a bill, Di.
Yes, absolutely.
And I suppose that you're right. It does depend on your personal circumstances, because if you are behind your goal on your pension contribution, which is typically your retirement goal and your longer term investment, you're getting tax relief on that. So every time you put that money in, you're getting 20% automatic uplift from the government. And with technology as well, you can track the goal. So you can see how far you're behind or in front from a retirement point of view, and how many years you've got left. I'm the same as you. I contribute to my pension and to my ISA because then you've got pension that you may pay income on in the future, but then you've got an ISA to fall back on, I suppose, which won't generate any income tax if you want some money out.
I think it's easy for us to talk about in here. We live and breathe this. Like, we know the technology, we understand what it gets, we know what's happening within the markets. This is what we do on a daily basis. But I think if you do take a step back as a run-of-the-mill retail client, clients are going to have different priorities. You are going to have life events that crop up where you might look and go, I wish I'd just done, I wish I'd spoken to someone, I wish that I'd put that money, like you say, into an ISA as opposed to a pension. And that's what the system's there to do. It's the system's there to say, look, these are your goals, relatively medium to long term, or would likely say you probably shouldn't be investing that. That might be your emergency fund that sits in the bank. The system is there to say, you told us that this is what you wanted by this date, or you wanted this amount of income in order to have a nice, reasonable, really nice quality of life post-retirement, give you a goal amount. And I think if I was using the technology as a client, I'd probably look at that and say, actually, where is my biggest gap to goal? How quickly can I fill that? And am I going to benefit more from that than just actually not really thinking about it and just putting a few £100 into the ISA or topping up as much as I can before tax year ends so that I don't lose it?
And I suppose putting into your pension or your ISA really dictates how you take it out. Because if you want to buy a car, then you know you can take that money out of your ISA and it's not going to cost you any income tax. But you could have a larger amount in your pension and then it could cost you some money in income tax to take it out. Yeah. So it's always wise to speak to a financial advisor, but certainly from a contribution point of view, you should look to max maybe your allowances out. I know a lot of people can't do that because it's a lot of money and most people don't, but it's wise to probably contribute to both and use up those tax allowances. Okay, great.
So this where the age thing is going to, because I know I mentioned it and I've mentioned it again, and I was like, based on my age versus Jen's. This when you ask Jen where she puts her money, she's going to go, I put mine into my ISA first. Yeah. So I'm not locking it away for that long.
Yeah. Do you do both, Jen? Or
I did have a phase where I'd upped my pension contributions for a little bit, but I've, like the example you've just given, I've just got a new car. Yeah. So I've had to put them back down and the money's now going back into the savings instead. So it does just depend on your circumstances, definitely. I know that I need to be sensible and have something easily accessible if something does come up in my flat or the car needs.
And most people have an auto enrolment scheme now, so there is a percentage that goes into that automatically and takes it out your wage. So it's that's decisions made for you, I suppose.
I like that Jen was polite and didn't actually come back, because I know you would have come back to the age thing.
Definitely, but then I'm not in a position to do that.
That's very true. Yes.
Okay, thank you. Well, we're going to finish off with one more investment question, probably for Paul. Well, definitely for Paul. With us seeing high employment data globally, does this present any market opportunities for investment?
Yes, it does. I think we've been really encouraged by how strong the labour markets have been globally, but we've been more constructive on the US market. So they've had low unemployment for a long time, but that's helped stimulate stronger wage growth. And with inflation come down, you're actually getting higher real disposable incomes, and that's fueling stronger consumption. But then you bring in what the US government's doing, which is spending a lot of money to generate pro-cyclical growth, and that's having a big effect. That's a very constructive environment for US companies, and that's why we've, for the last 18 months now, been overweight the US market. But we're also seeing similar dynamics in the likes of Japan. They've got very low unemployment and actually starting to see wages grow, which they haven't had for many, many years. That's been an excellent market for us as well. But in general, we're constructive on the growth outlook and the opportunities for equities. And so having low unemployment is very constructive.
Okay. And you mentioned there as well, being overweight in the US. That's the benefits of obviously having a diversified portfolio. We can make those changes with regards to what's going on in the world.
Exactly.
Change allocation, which is good.
But being active managers is not only just thinking about whether to go overweight, underweight, different areas. It's how you actually implement that. So you can implement that by just buying the broad equity market, or you can buy a certain segment of that equity market. So bringing active management, finding opportunities is really key.
Good. Thank you, Paul. Okay, great. Well, thank you everybody for tuning in today. That's the end of the Q&A session. If you do have any more questions, please email us at True Potential. We're quite happy to either bring this up in the next podcast or on our normal weekly podcast. But for now, thank you for joining. Please like and subscribe, and we'll see you on the next Q&A podcast.